Hey everyone, Jay Soloff from Investors Alley with our options trade of the week. So I'm back here in Market Chameleon looking for some interesting trades. We had another very big sell-off day with the S&P 500 down 2.5% and NASDAQ 100 down over 3%, and the Russell 2000 small cap down about 3%. So lots of selling going on. So let's look and see if we go here to unusual options volume and see kind of where some of the volume was that may not normally have been. Now, some of these are pretty big names that you would expect. Maybe pick something that stands out here, like so I would expect SMH, which is a widely traded semiconductor ETF. You would expect that to get hit fairly hard with the trade war issues with China. A lot of components and assembly being done in terms of semiconductors in China. Not to mention them being a potential customer for a lot of this stuff. So we look 143,000 option traded in this, with 87% being puts. So certainly negative. It was down 4%, so that makes sense. So maybe some hedging going on. If we go over and look at some of the trades over here in SMH, it's at about 110 after dropping almost $5 today. Sort here by quantity, and let's see what maybe some of the big trades were. All right, so this first one here is a November spread using the 190 puts. So what this is here is a ratio spread where someone bought the 100 puts and then bought twice or sold twice as many of the 90 puts. So this is generally a professional, institutional type trade, not the sort of thing you do at home. There is unlimited downside risk, well, unlimited down to zero anyways, because you're short more than you're long. But this is a pretty common hedge trade for institutions that have the margin to be able to do this sort of thing. So with the stock at 110, buying the 100 is your protection. The reason you sell twice as many of the 90s is because you're trying to cut the cost. So you could see that, buying 7,500 of these costs almost $2 million. But by selling double the amount of the 90s, you're getting $1.5 million of that back. So this is about a $500,000 trade that can make money all the way down to 90. So quite a bit of protection from 110 down to 90. It's below 90 where you run into trouble. Of course, the bigger firms, they have different ways they can hedge or cover their risk if necessary. But this very likely is a hedge trade, that does protect quite a bit of downside without spending a whole lot of money. Not the sort of thing you should do at home. However, nothing wrong with doing the 190 straight up put spread, spending a little bit more money and protecting yourself. Or you could go even higher up or do a narrower spread to save some money, 195 put spreads. So if you are bearish on semiconductors, or if you have a lot of semiconductor type stocks in your portfolio, doing a trade like this, some kind of put spread, is a good way of hedging. Once again, you don't want to do a ratio put spread like this because it's unlimited risk, but doing a similar trade without making it a ratio trade could be a good way to protect your semiconductor positions without spending a ton of capital, and allowing you to have those positions in your account and not having to worry about liquidating them. Now, if you want to learn more about this stuff, put spreads, vertical spreads, that sort of thing, check out my option trading mastery course. The link is on the page. It's a good 6-hour course divided up into 11 videos that can explain a lot of this option material and different strategies. All right, thanks very much, and have a good rest of your week.